My name is Michael Guyett, publisher of the Lead Lag Report. Joining me today is Karl Kaufman. Karl, first time you and I speak, but introduce yourself to the audience and to me. Who are you? What's your background? What have you done throughout your career? And what are you doing currently?
Yeah, thank you, Michael. It's a pleasure to be here, and thanks for inviting me. I started off, my first job out of college was as a stock market data analyst for Thomson Reuters, calculating index funds or indexes, since the S&P and Russell can't really report their own index numbers. They have to go to an outside source. So I was there for several years and left to kind of do my own thing and pursue my own thing. I'm really interested in the individual investor and trying to be a champion for the individual investor. About 10 years ago, I got together with my dad and we started American Dream Investing, which is a financial publication as well, sending just trades from our own portfolio as an individual investor to just kind of show people how a successful individual investor trades within their own portfolio. Since then, I've gone up to become a contributor for Forbes.com, interviewed guys like Jeffrey Gundlach, and wrote a book a couple of years ago. And I've taken to the Twitter and X platform about over the last year, just kind of sharing my thoughts. And it's my first Twitter space, so happy to be on here, thrown right into the fire. So this is great.
All right, so let's get into some of the misconceptions around being an individual retail investor. There is a term that's thrown around a lot that retail is, in quotes, dumb money. And I myself have always had an issue with that because it's not about intelligence, right? I mean, no amount of intelligence can increase the clarity of one's crystal ball. Nobody can predict the future, whether you're a professional or an individual. But I do think you can argue that individuals might be more susceptible to doing the wrong things, independent of their intelligence level. What are some of the things from your experience that you find individual investors, retail investors do wrong, which has nothing to do with how they think about markets?
Right. Well, I think probably number one is having an inflated sense of ego and thinking that, they're always right, not taking it on the chin, not owning up to mistakes. I think that's probably the number one mistake. And I'm sure many academic studies can support that. The hardest aspect of investing, and like you said, dumb money, smart money, it doesn't matter. The hardest part is definitely controlling emotions. And individual investors, particularly those starting out, as we've seen throughout the whole meme stock craze of the last couple of years, can get caught up in things and make poor decisions, whether it's, putting all their net worth in GameStop or AMC, or over diversifying, which I think is a mistake. I think having that experience and the knowledge that you're going to make mistakes is critical to success as an individual investor or any investor.
Do you think that social media has made the ability to control emotions harder? I mean, let's face it, engagement comes from that emotional pull. So as much as you can argue platforms like Reddit, like X, have allowed more individual investors to be confident in trading, I'd argue it actually makes them more likely to make mistakes.
Yeah, absolutely. It's easy to get caught up in the crowd, right? And it's easy to just find someone who seems convincing online and puts their thesis for investing in a stock online. I mean, it's just so easy to get caught up in all of that. And it's short-term thinking to the extreme, right? I mean, you're not even worried about quarterly reports or anything because it's all about what's happening this second. And you see that now even with Bill Ackman, the last, was it yesterday or the day before, where he said that he was covering his short position on treasuries, and the market reacted accordingly.
So I shared at the top of the nest one of the quotes from Philip Fisher. History has shown that in every age and in every field of human knowledge, many of the views which almost everyone accepted as true and never bothered to think about further were in time proven completely wrong. I want to apply that timeless quote to today from your perspective in terms of what is it that you think the Fed is assuming that people think the Fed is right on, but in reality may not be the case?
Well, like I tweeted today, the Fed and other economists are saying that, inflation is going in the right direction and we're getting closer to beating it. But, for the average person that goes to the supermarket or goes to fill up their car, I mean, that's clearly not the case. And I mean, food prices are not going down. That's for sure. Gas prices are, go up and down accordingly. But, the Fed is going with data that's lagging, right? And they've been proven to make mistakes throughout their history. I don't know why anyone would give them the benefit of the doubt at this point that they are not going to break the system at some point. You talk about a credit event coming, I mean, the signs are certainly there that something is going to happen, something's going to break, and we'll see. But I think we're going to look at this period of time from, say, the pandemic, even going back to the beginning of zero interest rate policy as a huge reckoning that's going to come. And, the Fed is going to be caught with their pants down, really.
What really concerns me, I just put a piece out on Investor Place. I had to not, usually I look at things from an averages perspective. I look at different sector ETFs to sort of get a sense of intermarket movement. But, if you look at some of these big bank stocks, Citigroup, Bank of America, Barclays, these things are, just stock price wise, it's almost like it's screaming that we're on the verge of a financial crisis. I don't know why it's not getting that much coverage.
Yeah, you look at Bank of America and the crappy loans that they have on their balance sheet. Are we going to go back to the too big to fail thing from 2000? The late 2000s. I don't know. I don't have a crystal ball, but what I do know is that regardless of what happens in the short term, I'm thinking long term, and that's for me has been critical to my success, to my father's success over the years, is knowing that whatever happens in the short term, the market will recover at some point. I mean, I'm in my early 40s, so I'm not so worried about retirement right now. I think if you are on the verge of retirement, you might have a different perspective. But whatever happens in the short term, preparing yourself and your portfolio for the long term, it helps me sleep at night a little better. And, it makes it fun to talk about at the very least.
But this goes back, I think, to the individual investors and quotes, dumb money. I think, if we agree that markets over time, you're better to be in equities than not.
Sure.
The problem, right, of course, is that most people don't think like that. Most individual investors have, I think, if I were going to argue anything, that the biggest difference between individual retail and, kind of more institutional, it is that time frame, right? The retail has to be much more shorter term. And I'd argue having more of a gambling mentality, right, with playing with options in particular than, real longer term allocators.
Yeah, look, I mean, retail could do whatever they want. That's one of the nice things about being an individual investor. So I think many people who got into the market, especially in 2020, there were no sports on TV. The casinos were closed. They viewed it like this is, I'm going to be gambling here with 0 day till expiration options. And I think that there's a place for short-termism and day trading if you really study it and you know what you're doing. I think it's a very good way to lose a lot of money very quickly. There's also plenty of retail individual investors that do take a long-term view of the market, and that's why there's a lot of buying the dip in stalwarts as opposed to the AMCs or the GameSpots of the world.
So you had mentioned a little bit earlier, you said over diversifying is a mistake, which I think is interesting because, that saying that it's like diversification, right? If you do too much diversification, obviously it doesn't help. But you do need to have some kind of diversification because, at the end of the day, it's about unknowable future paths, and you want to have arguably as many paths as possible covered in your portfolio. So how do you think about the point at which a portfolio is over diversified?
Yeah, well, I think an individual investor without a team of analysts working for them can't keep track of more than 15, maybe 20 at the highest investments in their portfolio. And, you get ETFs or index funds or whatnot, and you can claim you're diversified that way. But if you look at, the S&P 500 these days, the weighting of the top 10 stocks are so disproportionate, except maybe from the 1970s with the Nifty 50 or whatever. So it's the nice thing about concentration is if you're willing to spend the time and the work and the effort, you can really understand how a company operates. And some companies offer you diversification in and of themselves. I mean, Berkshire Hathaway is a perfect example of a company that has their hands in everything. And if you want to have insurance exposure and real estate exposure and a little bit of and some equity exposure, you get some Apple in there, you get some Bank of America. Who knows what's going to happen there? But you can be diversified enough with just a few stocks, I feel. And that's what's worked for me.
Yeah, and I think the problem is most individuals, they concentrate based on a chart or based on momentum. Whereas the reality is, if you're really going to do a true concentrated portfolio, you sure as hell better make sure you understand the company, the assets, the valuation, and have a different time frame.
Yeah, I mean, the fundamentals are what matters when concentrating a position like that. If you're in it for the long term, I mean, you need to know if the fundamentals are still there, if your thesis holds up over time. You need to be on top of the macro environment and the competitors. All of that needs to be taken into consideration as part of your research. I mean, unless you're, a professional trader, like a George Soros concentrating in something and using derivatives and such in a complicated manner. I mean, you don't need to be day trading within your portfolio unless you know what you're doing. I mean, I like to sell options, calls and puts against, the bigger positions within my portfolio. And that's how I stay active from a week-to-week perspective with my long-term positions.
Let's talk about some of those positions, if you don't mind sharing. What are some of the things that you yourself are heavily invested in? And then, when you take a concentrated position, what makes you sell out of it?
Well, Apple is my biggest holding by far. And I started investing in Apple in about 2010 and just been continually adding over time and selling it. I sold at 175, bought it back, continued to go in. I felt if I need to raise some cash, one particular reason I would sell a stock is for quote unquote accounting irregularities, which means they're committing fraud on the balance sheet. And so even if I really thought the stock had a good story, I would reconsider instantly whether that was the right call or not. If a company were to be acquired, I would sell because usually it jumps up right away and most of the gains are going to be right there. Other than that, it's only if I notice there's deterioration in the fundamentals would I consider selling a position. Really buy and hold for most of my things and then trade around it with some options.
The trading around it, are there certain rules that you follow, technical signals, or is it something that maybe can't exactly be codified, something that's more based on intuition? And I say that because I tend to prefer more rules-based approaches, although obviously it has not helped, But I do think that there is something to the idea that you can almost feel when things are getting extended without necessarily having some kind of technical basis.
Yeah, exactly. And, I'm a big believer in intuition and trusting your gut. I mean, all the academics would probably tell you that's not a good way to invest, and it's not something that could really be taught. It has to be experienced, right? You have to be in the market and have real money on the line and feel what it's like to lose money and to make money. And I'm a big believer in intuition. As far as technicals, I've studied technicals and I use it in some respects, mostly to kind of understand what the market is doing or, technical traders are doing. So I'll look at VWAP, I'll look at, Elliott waves and such, but it's mostly just to watch the chart and see if I'm planning on buying a stock, I'll take a look at the chart and see what would probably be a good time to get in or out, depending on the move I'm making. But for me, intuition is really key. Just from having watched the stocks every day for hours and weeks and months and years. And like I said, that can't be taught. That has to be experienced.
What's your intuition telling you now about where we are with stocks broadly?
I mean, if you look at what the market is saying, right? It's saying that they're trying to price in that the Fed is keeping rates higher for longer, but they don't really believe that's going to happen. Things are expensive in the tech world. I mean, your beloved Nvidia as a shining example of that. Talk about frothy and crazy. I mean, investors have really bought into the AI story like mad. And so I think we're due for a reckoning in the short term. I don't know how short. I don't know when that's going to happen. But I think that would present an opportunity for long-term investors like me to get companies that may have a tangential relationship to AI or more of a picks and shovel play, like like a Broadcom or even Intel being a dog that everybody has ignored for many years and thinks that they're late, they're behind everybody in the pack. I think that I don't know, to quote Lou Reed, but it's fun to be positioned to take advantage of whatever may happen. I mean, if things continue to go up, I'll continue to buy, or just hold cash and get 5.25% on that and wait for the striking price.
It's actually, since you mentioned Intel, there was, I forget who it was yesterday. I happened to have CNBC on, and somebody was saying that no company has been a worse steward of capital than Intel,
Right.
which is to be a strange way of framing it, because it's like, all right, that guy probably could never run Intel to begin with. No disrespect, but it's like, it's easy to quarterback and say things like that. But it does take a contrarian mindset to say, you know what, maybe consider Intel over NVIDIA. And that's not easy for most people to do. Again, going back to the individual versus, kind of the more professional allocator probably would consider doing that. Individual likely wouldn't. This gets into sort of contrarianism in general. I name the space Becoming the Contrarian Investor, because I think it's important for people to understand that there's two ways to think about investing, either your momentum or your mean reverting. Mean reverting is basically contrarianism. How do you define contrarianism, and how do you get the right mindset to think differently from the crowd? And importantly, how do you get the right mindset to know if you should be thinking differently from the crowd?
Yeah, look, there's contrarianism for the sake of contrarianism, right? And it's saying, well, this stock is high, so I'm going to sell, or, I have to be different from everybody else. I don't think that gets you very far, because you're relying more on luck than anything else. You're basically just doing an inverse Kramer kind of thing, or a George Costanza, where you just do the opposite, right, of what you think everybody else should be doing. I think contrarianism, to be successful, has to be backed by thorough research and real deep thinking. I mean, I just revisited Howard Marks' book, The Most Important Thing Illuminated. And he starts off right away with his second level thinking, right? Which is asking yourself some specific questions to really put things in perspective, right? Like, why would things be different from what the market is telling you? What would have to happen in order for your reverse case thesis to come true? How does the current price comport with the consensus view of the future and with mine, is one of his questions.
Just to reset the room for the remaining 20 minutes, everybody, please make sure you follow Karl here on X. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be in podcast under Lead Lag Live on all of your favorite platforms, Apple, YouTube, Spotify. You had mentioned your father a few times. I've talked and been very public about kind of my own family history. I'm curious a little bit about the origin story as far as you and your father, the family involvement in investing. What has he done throughout his life, and how did it impact you?
Yeah, and that's what makes me so passionate about trying to educate others, is because I was so lucky to have a father who made it a priority to teach me and my brother about investing principles. It's not taught to the same extent in schools, obviously. But my dad was a scientist for craft foods. He packaged bottles and cans for like Kool-Aid, right? The first member of he was completely self-taught, and he found that he was making more money investing in the market than he was at his job. So he retired relatively early and started doing full-time. And he was able to triple and quadruple his net worth in retirement. So he taught me a lot of the principles I'm talking about now: contrarianism, not always going along with the crowd, trusting in your gut, concentrating in a position. And, we started the business in 2016 because all his friends kept asking him what to invest in. So we thought, well, why not just share it with some people, make a business out of it? And so sadly, my dad passed away right before the pandemic, leaving me to take over the family portfolio and make sure my mom was taken care of, and that the principles that he used to build wealth would continue throughout the generations, hopefully. And I plan on teaching it to my two young children as well. So it goes back to not settling for average and thinking differently from others and really finding a passion for it. And it's a belief that maybe not everyone could do it, but anyone with the right mindset and drive and passion for it can do well in the stock market.
Were there things that, as you proceeded along your own investing journey, that you found you disagreed with in terms of the way that your own father would look at markets? I say that as somebody who also, grew up with my father in the business. There are things that I agreed with him at the time, but then obviously as I got older, it's like, all right, well, maybe he wasn't exactly right on that. I'm curious about that part of it because I think that, there's a natural tendency to want to believe that everything your father says is accurate and true, but, the reality is they're human.
Yep, absolutely. Absolutely. That's a great question. I mean, the big thing for me, my dad always had CNBC on in his office all day, every day. And for me, I think that was almost a detriment to my own research and my own understanding. I still listen and watch it on occasion, but for me, it's just noise. And I like to listen to CNBC or in the car or, watch it on occasion. But for me, the value of CNBC is watching interviews with CEOs whose company I own, whose stock I own, so I can kind of get a feel for them and see if I can see how they answer the questions and kind of gauge if they're telling the truth or not. I think that's very interesting. I also listen to it, basically see what everyone else is doing, because if you watch or listen to CNBC, everybody has the exact same opinion, pretty much. I mean, they all fall in line. Nobody wants to be like, the crazy hopped up Price is Right contestant saying, the stock price is going to be 3 times higher or 3 times lower than everybody else. So it's interesting to see what everybody is saying. And then I can go about seeing if I could poke holes in it and if I can come up with my own kind of contrarian take on that.
And part of that's also learning from others, obviously beyond just your father. I know you had mentioned that you spent some time looking at some of the, in quotes, greats when it comes to investing. Maybe just share with the audience some of the more interesting kind of investment, in quotes, legends that you looked into, that you've studied, and if there were any kind of commonalities across them.
Yeah, my dad always liked Warren Buffett, but never owned any Berkshire Hathaway stock. And I bought some for my own portfolio and have studied Buffett's, his letters more so than my dad ever did. Peter Lynch was, One Up on Wall Street was the first book my dad gave me when I graduated from college. And that was kind of what started my real passion, knowing that I could connect to my dad that way. So I love Peter Lynch. I love how he encourages the individual investor, and his writing is just so wonderful. Philip Fisher, you have there is great. Howard Marks, even George Soros, as demonized as he may be, I find his writing to be fascinating on an intellectual and philosophical level, as far as his feedback loops on the market. So I think there's a lot to learn from the great investors, but the key is not just copying them. It's synthesizing bits and pieces from them all and coming up with your own philosophy and using that to guide you as you go along, learning and studying the markets yourself.
Yeah, no, I think that's very well taken. I also think that it's important that people not, to your point, try to imitate another investor. Being an investor is more than just a set of rules, right? It's temperaments, it's your own individual sort of risk tolerances and dynamics. I don't think anybody should ever think about cloning somebody, because you have to find what also works for you as an individual.
Yeah, I mean, you look at, say, Monish Pabrai, who is an admitted clone of Warren Buffett, right? But I don't know anyone else who's that successful doing it. Now, look, I mean, part of my business model is sharing my trades with members of my service. But, I send that information to people who can do what they want with it. I mean, they're not going to be able to fully copy my results because everybody's got a different scenario. But it's good to get different trading ideas and to see how an investor trades within their own portfolio. I mean, especially with, say, options trading. I don't do weekly option trades. I look all the time for opportunities, but I sit back and wait for my pitch and try to be patient instead of swinging at every pitch. So there's certainly a lot of value to get from seeing what other people's trades are. Now, for people who copy, say, Warren Buffett based on a 13F report, that's not up to date. So that's lagging data as well. You don't know what Warren Buffett and Berkshire or Bill Ackman or any of those guys have done over the past several weeks since the 13F was filed. So I don't recommend doing that, but it's good to get ideas from a variety of sources and see how these investors are going about managing their own portfolios.
When you have a concentrated portfolio and you've got your view on things, arguably you also have a lot of time, right? Because it's like, I get that you're trimming and using the intuition side to manage weighting, but for the most part, you have some time. But I'm curious, what do you do in your free time? I mean, is it just kind of reading about markets? I mean, I think when you're passionate, you're just interested in the way the world works, the way money works, even though you're not necessarily doing anything with your portfolio.
Yeah. I mean, I'm looking for new ideas. I'm reading whatever I can get my hands on. I'm also writing a lot. I find that writing helps to kind of process my thoughts and my ideas, and trying to have conversations with people and reaching out. Currently filming a course that I want to do for kind of beginners to try and get them to start, because so many people are just overwhelmed or don't know anything about the market. They don't even have any exposure. I mean, if I can convince people to just put some money into an index fund and set it up automatically, I think that'd be a good way for most people to just get started and then move on to more advanced topics from there. So, I fill my days with a lot of different passion projects. Very lucky that way. And, writing and reading and talking about the markets, it could last me the rest of my life. There's always something new every day.
Yeah. And I think there's never a dull moment. and there's always more to learn. And also, I think more in time, the more time you spend investing, the more you realize you have to be humble and have humility, because, I keep going back to the idea of don't embarrass somebody who's going through a hard time in a particular cycle, because it's probably going to be your turn next.
Yeah. I mean, I try not to call anybody out by name, even when I'm calling about out of touch economists. There was one in particular that I had in mind, and I decided against actually calling him out by name. It's too easy on Twitter to just troll people, as you're well aware of. But yeah, look, people go on CNBC all the time and their predictions are proven wrong, and nobody holds them accountable. And then they get invited back, which I don't understand, unless they're way out there.
Well, I'd push back. I think it's okay to be, because everyone gets it wrong on predictions. I think where the media fails is they don't call out thought process, right? So you can be wrong, but still have the right thought process, right? So it's a question of, what I always say, it's like the left of the equal sign versus the right. I think the problem with the media is they're always looking for the soundbite, which is after the right of the equal sign. They don't question if the reasoning is valid to begin with.
Fair enough. And, everybody uses a qualifying term. They say the market could do this, or, there's a 40% chance that Apple will buy Netflix, or, this way, they can make predictions and not say, well, I didn't say it was going to happen. So I think every prediction should be taken with a grain of salt, and that's not to say they should be completely ignored. I think a lot of people do a lot of good research and share it. And, I think you could take the better ones, those who have better track records of being right, or have, to your point, a better explanation to why they came about their thesis. And it makes for good material to try and poke holes in it.
Yeah, it's unfortunate that you don't have more of that intellectual honesty. I think, long form podcasts, you can somewhat get there, but the problem, I think, even with podcasts that I myself have listened to, is a lot of the hosts don't necessarily understand markets to know if there's holes in the argument, right? I think that's a whole nother dynamic. And that kind of makes sense, right? Because, unless you're doing it from a content generation perspective, like I am, while also running money, it's not really your job to know. It's your job just to get the guests and, get questions.
Yeah, no, that makes a lot of sense. People love to trust people and who they think they are experts. But the thing with the stock market is that nobody really knows what the future holds, right? You could be the smartest person in the world and still get it wrong, because there are a myriad possibilities of what could happen in the future. And everybody still gravitates towards whoever says their prediction with the most conviction. So, I think there's value there, but it pays to really do your own due diligence. And that goes with anything.
100% agree. Karl, for those who want to track more of your thoughts or get access to some of the things that you put out, obviously the financial education side is important to you. Where do people go to for that?
Yeah, you can find me at americandreaminvesting.com. I have a newsletter I publish every other week for now. And here on Twitter, the Karl Kaufman is my handle. I publish, I have some kind of tweet every day for the most part since the past year. Those are the best places to find me. I haven't published anything on Forbes.com in a while, but looking to pick that up back again. And, happy to answer any questions or, feel free to shoot me DMs. My DMs are open if anyone has specific questions. It's a lot of fun just talking about the markets.
Everybody, please give Karl a follow here and make sure you give kudos to him because he is trying to help others, which I think is important in an industry where there's a lot of bullshit things that are said and espoused. Thank you, Karl. Appreciate it.
Yeah, thank you, Michael. This is great.